There's one asset class we haven't heard much about recently, and that's commodities. And that's because they've gone right off the boil. After a peak a couple of years ago, the momentum has been downwards, particularly in metals. Also, their relationship with stocks has changed. For a while, metal prices used to move almost exactly in line with stock prices. That relationship has now broken down completely. And there's quite a strong consensus that there will be nothing exciting from them in 2014 either.
You know, short term, there are attractive ways to invest around commodities. Some of the smaller base metals are attractive to us. Longer term, commodities look to us a bit like the volatility of equities and the return of bonds. So it's not a place that we'd put a strategic asset allocation as a main focus for 2014.
Now, a while ago, there was speculation that commodities were part of a rising wave. The commodity prices would have to keep growing as populations grew larger and richer and demanded more. But that logic looks faulty.
Contrary to popular belief, commodity prices tend to trend downwards over time, and over the course of the 20th century, commodity prices are dramatically lower than they were at the start of the 20th century. So there have only been a number of occasions when they've been lifted upwards by specific events, so World War I, World War II, the OPEC embargo, now the rise of China. Once you remove that specific driver, the natural tendency reasserts itself and they once more drift downwards.
As for the commodities that attract the most attention, oil, as we're measuring for you here with Brent crude, has been very stable for several years. But given that we've now had the shale gas revolution in North America, which has drastically increased supply there, and we also have the possibility of extra production from countries like Iran and Libya, where production has been disrupted by wars and unrest, it would look as though oil's risks are distinctly to the downside. And then there's gold, which fell more than 20% in 2013.
It doesn't look like 2014 will be good for gold. A lot of the factors that drove gold prices up over the past few years are now starting to unwind. There's more certainty about the US growth outlook. Real interest rates are starting to rise. There's less concerns about runaway inflation in the United States in particular. So it doesn't look like 2014 is going to be a particularly good backdrop for gold prices.
However, it might still be too soon to call the end to this upswing in commodity prices.
Well, I'd say in commodities, I'd say we're in sort of the third quarter of the commodity super cycle. So in my view, the commodity super cycle is not dead. There's still too much debt in the world. But we're sort of on pause, a bit like we saw in 76, 77 into 78, when commodities don't really do much, and some of them have been beaten up quite badly this year. So I suspect that'll continue next year because money tightens. But I think as you get a year or two further down the line, we'll see that actually recessionary conditions return, money printing returns, and commodity supercycle reemerges.
And there's another point. Commodities follow a cycle for a reason. Once prices drop, supply drops. That then pushes prices up again. That process is underway.
2014 is going to be the first year since 2010 when all the major regions in the world are growing at the same time. And commodities have suffered because there's been concerns about levels of economic growth. And generally speaking, they're now moving down to price levels where it's becoming uneconomical for marginal production. So that's having an impact on the supply side. But I think that in an environment where expectations will be for rates to rise slowly, and bearing in mind commodities pay no income, it's hard slogging.
Perhaps the best that can be said for commodities is that there is such a strong consensus that they will do badly. If there is potential for a positive surprise in 2014, it looks most likely to come from commodities. But with the world still looking more in danger of deflation than inflation, it's hard to recommend anything more than a prudent and small allocation to commodities.